On March 8th, the 2-year versus 10-year yield curve traded at an over 40-year low of negative 108 basis points. This print came the day after Federal Reserve Chairman Jay Powell's testimony to Congress, in which he said he was open to increasing the size of coming rate hikes. Now, in the following days, however, headlines emerged of massive stress in the banking system tied to principal losses on Treasury holdings. The initial concern was of a potential bank run of depositors taking money from smaller banks and transferring it to larger, better capitalized banks. The market began to lose confidence in future rate hikes, and as a result, the yield curve inversion moved up to negative 39 basis points. Now, at the March 22nd FOMC meeting, the Fed expressed some concern that the banking issues could tighten financial conditions and serve as a synthetic rate hike. The market took the implication to mean that the hiking cycle may be over, and then began to aggressively price in rate eases in coming months, totaling 50 basis points in the next 9 months and 150 basis points by July of 2024, this according to the CME FedWatch tool. Now, if a trader believes that the current direction of the yield curve inversion could continue toward zero, a trader could express that by buying the April micro 10-year Treasury yield futures contract at 3.55 and selling the April micro 2-year Treasury yield futures contract at 3.90. This represents buying the spread at negative 35. A target for this trade could be placed at 0, and a stop could be placed below at negative 55. Now, this trade could make $350 if the target is reached and risks $200 if you're stopped out at your level. A reminder that stops have to be monitored in this because we're using 2 different contracts. Now, if a trader believes that the yield curve could head back to a deeper inversion, they could express that by selling the April micro 10-year Treasury yield futures contract at 3.55, buying that April micro 2-year Treasury yield futures contract at 3.90. Now, this represents selling the spread at negative 35. A target could be set near recent lows at negative 100, and a stop could be placed above at positive 10. This trade could make $650 if the target is reached and risks $450 if you're stopped out of your level.